Welcome back to the channel, guys. So I want to talk to you today about something that each one of you need to be thinking about. Everybody that becomes a real estate investor really needs to be thinking about this for your future. Okay, I know a lot of us are tied up in today's deal and what we're doing today, and we're trying to find our first deal or that next deal, because a lot of you guys I talk to are new, and even you guys out there that's been doing it for a while. You closed a few deals, and you got some experience there. You got some maybe some guns under your belt. You're ready to go. You got a little money in your pocket and all. So today I want to talk to you about your future, and I want you to understand very, very clearly that in real estate, you can make that today money, but you got to think about your future, and everybody does. It doesn't matter who you are, what stage you are in your investing, no matter where you are, you've got to think about your future. Because today money is great. Well, if the economy busts or something, or we have a slowdown, or home prices change, a lot of things, interest rates can change, all kind of variables in the market. There's like so many variables that can change real estate in so many ways. I want you to think about your future. Okay, so let's just say you guys, some of you that have been doing it for a couple years, you've got some deals going, you've made a little money, you kind of understand the game. I want to talk to you a little bit about buying assets. So first of all, let's make clear what an asset is. Okay, there's asset column and there's liability column. Okay, and I'm just going to use examples like your car. Your car is not an asset. Even if it's paid off, it's a liability, because it's always going to cost you something. It breaks down, you need tires, you need motor, you need oil changes, or a transmission could go out, or 25 other different things. It's always losing value. If you buy a brand new car today, next week it's worth less than you paid for it today. So that is not an asset. Okay? Assets are things that either make you money or they appreciate and make you money, not depreciate and lose you money. Okay, so of course real estate is, to me, by far the best asset out there. I mean, you can have stocks and bonds and things like that, or crypto, or any these other investments, but most wealth has been gained in this world from real estate in one form or the other, whether it was an inheritance of real estate, or buying and selling, or buying and holding, or somebody just happened into a good deal, or development, or whatever it may be. But you need to start thinking down the road, because here and today is where you are, and the money might be great, and you might be kicking back 6 figures or whatever, maybe even 7 figures, in your business. I know some of you guys, I say that, makes you a little jealous, because you're like, I just want to get the first deal. But it doesn't matter where you are, okay? You need to be thinking about your future. So even if you're the guy waiting on the first deal, and you get the first deal, the second deal, the third deal, you made a little money, start thinking about the future. Start thinking about the assets. So as you're out there and you're looking at deals and you're analyzing deals, and if you're doing your numbers properly, and I teach everybody how to run their numbers properly, because I don't invest in deals that don't make money. I am not interested in a 10% spread or a 20% spread. That is I'll just say, for me, okay, a waste of time. Now you might be in a different position where you think a 10% profit is great. I think a 10% profit is terrible. That's a market fluctuation. So let's go back to the assets. So if you're buying, and you're looking at deals, and you're analyzing all these deals, and you got them going on around you, and let's just say you got 5 or 6, and you got one over here, boy, that looks like the cherry. That's the low-hanging fruit right there. If you have the ability, or you have a way in somehow to add that to your portfolio, pick that low-hanging fruit, stick it in your portfolio. Continue with your other deals and keep doing deals and making money, but take that low-hanging fruit and make that an asset for you. Because if you bought it like you should have bought it, to where it's actually going to make money, no matter if you have to rehab it, or if it's a rental, or a buy and sell, whatever it is, it doesn't matter. It's the low-hanging fruit that you're going to keep for yourself. It may be the area that you're in. The area that you're in may have a high appreciation rate. You might be in a city or in a town, or in a certain part, like in Jacksonville, Ponte Vedra Beach. Had I bought property in Ponte Vedra Beach, 20 years ago, 25 years ago, whenever I started this thing, man, I'd have been like, I'd have been in good shape today, because the prices and the development and even the availability of homes has changed out there dramatically. See, but I wasn't looking into my future. And see, I can tell you guys to learn from my mistakes, because in life, the mistakes that cost us the most are the mistakes that we remember. Those are the mistakes that we learn the most from. I learned myself, from some of the mistakes that I've made out there in my real estate buying, career, and in my investing career, or whatever you want to call it, time, whatever. And I can see and reflect back and say, my mentor told me, just like I'm telling you, he told me to do this and this, and I just kind of like, yeah, well, I'm making great money today, I'm going to do this thing today. But I'm telling you, because I went through the recession of 2008, man, and literally it was bad. It was bad, okay? So I've seen it bad. Now, a lot of you people are younger. I mean, a lot of you guys are younger than me. I'm at the time of this recording, I'm 58 years old. I'll be 59 this year. So I've lived through a couple of bad places in time, and in the real estate market in my lifetime, 2008 was probably the worst that I've personally seen. There were other points, highs and lows in between. Even in the 80s when I was in school and all, there was still some bad times in real estate. But in my conscious investing part of my life, 2008 was probably the baddest time. And I'm telling you, this could happen again. And that's why I say we invest only with a safe strategy, okay? I only like to buy properties where I have, and I mean, don't think you can't, because I do it, I've done it, where you have 30% or more upside after everything is paid. I'm talking about your rehab costs, your holding costs, your closing costs, everything in between, all right? So to me, that's a solid investment. 10%, like I said, that's a market fluctuation. I lived through 2008, and I saw the market fluctuate way more than 10%. I saw the market plummet by 20, 25%. And in some areas, it literally went further than that. So that's why I'm talking about the slow-hanging fruit in certain areas. Now, is every area going to be that way? No. But within most cities, municipalities, even in some of the more rural areas, there are areas that are more stable than others, like Jacksonville, because there again, I have to use Jacksonville as an example because it's closest big city to me. I invested a lot in Jacksonville. Your beaches area is always going to stay up. Now, some of the beaches area are not as good as they used to be, but in your middle to upper line beaches areas are always going to be good. Your waterfronts, like, we have the St. Johns River, we have the Intercoastal Waterway, we have these areas that are going to be good. And there are cherry deals that come available in these areas. Even in Sawgrass, a lot of you know what Sawgrass is, where they play the TPC, the big golf tournaments and all. These areas, I see foreclosures in there. They might be $3 million houses, under foreclosure in a area that has a typical like $350,000 Jacksonville, general price. So when I tell you this and I say that there's low-hanging fruit, it is still out there. Now, you have to get good and you have to get skilled at your craft. Your craft is real estate, okay? You have to get good and skilled at your craft to where you can find these deals, because they happen. The foreclosures happen, the death happens, the accidental things happen, divorces happen, bankruptcies happen. All these things happen in these cherry areas, just like they do in some of the not so cherry areas, okay? And just like Jacksonville, for instance, I've seen over the last 30 years, I've seen a huge shift in the market in certain areas, and certain areas have gone down, in price, or even though they've appreciated where they would have appreciated to, they're not at the level that they would have been, let's just say 30 years ago, gaining value. So the appreciation rate might have been, 5 or 7%, where now it's only like 2 or 3%. So when you look at your cherry, your low-hanging fruit deals, okay, you got to make sure that you buy right. You got to buy with that good profit in there, even if you're, looking at having to do work. It doesn't matter. The numbers still work if you're running your numbers properly. If you're following me, ain't no doubt, I'm going to show you how to run the numbers. If you've looked through enough of my stuff, you're going to see that I'm telling you how to safely invest and make money on every single deal. Don't do the deal if it's questionable. Just move on to the next one. There's too many. Okay, the field is too wide, and there's too much to harvest out there to worry about trying to make $5 grand on a house. It's just, your time is worth more. You're trying to trade your time for dollars, and you're thinking in your mind that Well, let's see, I could make $5,000 or $7,000 on that deal, man. It'd take me, so many weeks to make that at my job. Stop thinking about, trading your time for money and start concentrating on the numbers and on the deal. Okay? Because there's only so many deals to go around, but there's plenty. There's only so many cherry deals to go around. There's a lot of deals. There's a lot of marginal deals. There's a lot of them $3,000, $5,000, $7,000 profit deals, which is nothing. If the market fluctuates like that, that's gone. Even if you bought it on owner finance, even if you did it as a sub two. And I bought a bunch of sub twos back in the day, and I don't do much on that anymore because it ain't worth me fooling with. But the sub twos, a lot of those are very low equity deals. So when the market goes south, especially in somewhere like Florida, California, Texas, some of the other places where the market falls first, like my market did in Jacksonville, and it will again. There's no doubt it will again. You want to be, as I said, conservative, and a 10% profit is not a profit. I'm telling you, if anything happens, a lot of investors that are here today listening to these gurus out here, they're going to lose. I mean, if you're holding 20 or 30 sub twos, and things start going south, and the bank can call them sub two loans. The bank starts calling those loans, or property prices were here at 400,000, and 2 months later they're at 300,000 and sinking. You're done. You can't rent it, because not only did the property prices go down, same thing happened in 2008. The rental rates went down. Okay, so the property values plummeted, but the rental rates plummeted too, because now everybody's desperate to start renting their properties because everybody don't have any money. I'm just setting you up and telling you that this can happen. This is a very real situation, scenario anywhere. So that's why I say we invest safely. Okay, we only invest in properties where we have at least a 30% upside, because most of the time you won't lose 30% of the profit that you bought whenever you bought into the house. Okay, so as I said, let's go back to the low-hanging fruit. The low-hanging fruit is the ones that you want to stick over here in your portfolio. You might have 50% profit in it, and if you're making good offers, if you're running your numbers like you're supposed to, and you're actively out there, you'll find these deals to stick in your portfolio, even if it's a sub two, and most of them won't be. They're going to be hard money loans, or maybe an owner finance deal, that needs some work or something, or one of 3 or 4 other creative ways that you can get into that deal without having to take any money out of pocket, and you can hold that property for a number of years. You'll have a huge upside. Like I said, it's great to make money today, but the taxes that eat you alive if you make a lot. If you make $1 million wholesaling in a year, and you go to the tax man, you're going to leave there crying. I can tell you right now, you're not going to be happy whenever you leave there, because what he's going to tell you have to pay on that capital gain, you're going to cry. So if you divert some of that cash over into some assets, and I'm not offering any tax advice or legal advice, I'm just telling you the facts. If you divert some of that cash over into assets, because if you're doing a lot of wholesaling and you're doing some deals, you're going to have some cash. Okay, instead of giving it to the government in taxes, take that cherry, that low-hanging fruit, put that money in that low-hanging fruit, stick it back in your portfolio. You may only buy 2 a year, but if you buy 2 houses a year, just 2 houses a year for the next 10 years, and if you hold them for 10 years, by the time, just 2, by the time you sell those houses 10 years later after you've held them, they're going to appreciate, number one. Your debt's going to be paid down, number 2. Okay? If you're in the right area, like I'm talking about, and you guys know where it's at in your town, you know where the bullets is flying. This is not where I'm talking about. You know those nicer waterfront homes, or those areas that seem to maintain, over the past times, a better price point. Those are the areas that you are really going to see some appreciation in. You're really going to make some money in, and whenever you decide to retire, let's say, you decided to retire in 20 years, man, you're in great shape. I mean, you're in great shape. You have pushed those taxes away from you for all those years. You won't have to pay them. You've got those assets, that you could sell. If you just wanted to cash out and sell, man, and just pay the taxes on it whenever you sell it, you're still going to come out with a lot more than you would had you wholesaled it now. You might make 30 grand on it today, 40 grand wholesaling it today. But 20 years from now, that value of that 40 grand may be 140 grand. And see, if you pay the taxes on that, you still come out with way more, and you had a performing asset through the years. Because like I said, you have to buy right. You have to buy the low-hanging fruit as your own personal portfolio. And the more houses that you look at, the more you're going to see. Some of you more experienced guys out there, you know exactly what I'm talking about. You've done seen those low-hanging fruit. You've done seen those high-margin houses where you make 30, 40, 50 grand on assignments. Some of you even more. Some of you 100 grand on assignments. And I know to the new guys that are watching this, that seems impossible and that seems hard because you're struggling to get a deal and make 5 grand. But it took them time too. Like I said, real estate is a marathon. This is not a sprint. You're not going to run out there overnight and get rich. I mean, the number of people that are going to do that are so small and so minuscule that they almost don't exist. So it's a long game. That's what you're playing. You're changing your life, you're changing your career, and in order to do that and play the long game, that's where the low-hanging fruit comes in. Because the long game is what that low-hanging fruit is for. That's going to give you the most appreciation and the most gain and the greatest tax benefit today. Okay? So think about these things when you're out there looking at properties. Think about these things while you're out there going through your deals. And when you see that low-hanging fruit, man, pick that sucker off and put it in your portfolio. I mean, if the numbers work, just like I've tried to teach you guys, and I've shown you in some of my other videos, and those of you that are my student, you know exactly what I'm talking about, and you know how to do it, and you know what the numbers are, man, you're going to be surprised. Just 2 houses a year. 2 houses a year. Don't take sub-2s that have no equity in them and wait for 20 years worth of appreciation. That's called speculation. Speculation, there's a lot of real estate investors in this country that have went bankrupt on speculation. You're not a speculator, you're an investor. An investor is not a speculator. A speculator is someone who's looking at something today and hoping that 20 years from now they're going to be able to get more for it down the road, and they're speculating that it's going to be more profitable. Forget that. You make your money when you buy. That is when you make your money. You cash your check when you sell. Okay? So buy right, pick the low-hanging fruit, stick it in your portfolio, just 2 a year for 10 years. Just do it for 5 years and get yourself 10, and then hold them for 10 more years past that. You'll retire a wealthy person. You will retire a wealthy person. I hope this helps you guys out. Subscribe to my YouTube channel. Come by and see us, House Flipping Masters, at the Facebook group. Keep following and watching, because I want you to succeed. I truly want you to have the life you've been dreaming of, and I want you to change your life and become someone tomorrow that you're not today. So come back to see me, guys, and we'll have some more really good tips for you.